In San Francisco, this is Bloomberg Technology. Coming up in the next hour, all about user growth. We dissect Snap's third quarter earnings, including daily active users up nearly 2% above analyst estimates. Plus, a barometer for the chip industry. Texas Instruments reports a big miss on revenue. Shares are dragged down in after-hours trading. We'll have a report. And Libra grilling. Facebook CEO Mark Zuckerberg is anticipated to field lawmaker questions on the social network's controversial cryptocurrency on Wednesday. We cover what to expect. But first, to our top story. So Snap fell as much as 10% in late trading after reporting third quarter earnings. The company reported revenue and user growth that beat analyst estimates. It has been boosted by an increase in downloads of the revamped Android version of its app, but questions still do remain about long-term monetization. To break it down for us, I want to bring in Jitendra Woral of Bloomberg Intelligence. So first, let's talk about the third quarter and the daily active users. I have a chart here that I'm showing in my terminal for our audience. Seemed like those daily active users knocked it out of the park.
Yeah, they did. So Q3 numbers were pretty strong. Actually, it's the Q4 guidance that fell short. But we have to look at the backdrop here. You know, the stock is up 154% year to date. And the valuation, to sustain that valuation level, the expectation was an even stronger 4Q guidance, and that sort of fell short. But actually, like you said, the user number, you know, that is the hardest one to really beat, because everything else is in their control. They can ramp up the monetization if they want. They can, you know, cut cost if they want. But the user engagement and user growth, that's the harder metric. So the fact that they are projecting better than expected user growth in 4Q as well, you know, it's telling you some of these changes are working, are showing results, and fundamentals should follow. But this is basically what you're seeing is a mismatch in, you know, what the expectations were going into the quarter, which was much stronger 4Q guidance. And
so that's the part of the share price reaction that we're seeing late Tuesday. Expectations really had gotten ahead of themselves going forward.
Yes, especially for the 4Q guidance. You know, the bigger question here for Snap is one of longevity, right? So if you look at expectations for this company for the next 3 years, their revenue is expected to more than double. And the bear case scenario doesn't really believe in that, right? And especially given ongoing competition from Facebook, from TikTok. Now, obviously, these user numbers are telling us that they are fighting back pretty well. But to instill faith in that long-term expectation, they need to do this quarter after quarter in terms of showing that the user engagement remains and continues to grow.
You talked a little bit about competition. Instagram came out with a competing product called Threads. TikTok is increasing competition for Snap. How much is competition a real headwind?
In some international markets, it'll be a very big headwind. But in the core markets, what we're seeing is, at least, you know, over the last 2 years, really, they've been fighting with Facebook, with Instagram, and it has been pretty resilient. In fact, you know, we saw the numbers today. The average daily Snapchat users opening the app 30 times every single day. So it's showing you that the core audience engagement is still there. Now, they are focusing more on driving original content, localized content, you know, add more AR features, filters, sort of to keep this engagement steadily increasing, because their monetization level is still below the peers. It's still below Twitter. It's still below, much below Facebook, and things like that. So as far as they keep the steady pace in user numbers and user engagement, they can fall back on the monetization side to drive revenues and fight with competition.
So often, as you know, in the space, we talk about long-term revenue, which looks good. The margins, you said they're pretty effective at cost cutting. Not profitable yet. Did we learn anything about any update on when we could see this company start to turn a profit?
So there's a possibility that by 4Q on an adjusted basis they'll break even. The GAAP profitability will take a couple of years, but this is quite a big step since where we started. I mean, if you remember, negative gross margins when they IPO'd, close to 50% right now. So they are showing progress towards some of these things, but the overarching number to watch for, even longer term, remains the user number, because all the fundamentals really follow that trend sooner or later. And as far as they keep that up through innovation or original content or these kind of things and show results against that, then the long-term confidence in their longer-term growth story will grow and the valuation will follow.
Well, you heard it there. Follow the long-term numbers. That was Jitendra Woral of Bloomberg Intelligence. Thank you for joining me. Now, SoftBank is taking control of WeWork. The rescue plan will result in founder Adam Neumann leaving the board of the struggling office rental startup. But he is not going away empty-handed. Neumann is expected to sell $1 billion of stock to SoftBank. He can also assign 2 board seats and will get a $185 million consulting fee. To discuss, I'm joined by Bloomberg's Leanna Baker. Leanna, is this the beginning of what looks like the new WeWork?
This is that bailout package that we've been waiting for weeks now. We've been trying to understand how WeWork will keep the lights on, and it looks like SoftBank, one of their biggest investors, is coming to the rescue. And Adam Neumann, the charismatic CEO and founder who had stepped aside a few weeks ago as CEO, is also stepping aside from the board. So he will give up his board seat. He will have an observer role and be able to appoint some board members, but that hands-on role he'll be giving up. So it really is the start of a new chapter for WeWork.
Can you talk to me about how realistic some of these numbers are when it comes to Adam Neumann? He's walking away with as much as $1.2 billion, $185 million consulting fee, a $500 million credit line extension. Is that fair and normal?
It definitely raises some questions of governance, but remember that Neumann owned a controlling stake in the company. So to get Neumann out gracefully, SoftBank did have to pay up. He wasn't just going to go away. This was the company he founded, and he did have that stake. So it's unclear how the negotiations went down, and WeWork hasn't confirmed on the record any of these numbers. So we're still waiting to hear what the company has to say. But to be sure, Neumann's put in his work, and he's getting a pretty package here to get him out of the picture.
Leanna, Shira Ovide over on the Bloomberg opinion side of things came out with a pretty scathing column talking about where is the board of directors and their accountability on management, particularly because they chose the SoftBank deal over the JP Morgan deal, which does dilute existing shareholders. It lets Adam Neumann walk away with X million dollars or so. Where is the board of directors?
The board of directors was careful to hire outside advisors, a law firm and a bank, to advise it on which package made sense. JP Morgan had tried to put together a compelling rescue package of their own of $5 billion. They had received some outside investors. It had been reported like Starwood was going to invest, but the board did decide this was the better route, and some might say that SoftBank is the more stable outcome for the company. SoftBank had already invested over $10 billion, and they're coming to the rescue again with almost another $10 billion. And they have deep pockets that could keep this company operating. But the board did hire all these advisors to make sure there wouldn't be any lawsuits or other corporate governance crises, because there's just been so many already at this company.
So pushing the story forward, what can a new co-CEO, 2 of them, a new chairman do that Adam Neumann could not do?
You mentioned 2 co-CEOs, but we've reported there's actually another executive coming in, Marcelo Claure. You might remember he was the CEO of Sprint and executed a turnaround there. So he will come in as chairman, replacing Neumann, and he may lead a search for a new CEO. So there could be even more fresh blood into this company. The co-CEOs running the company right now, they were there during Neumann's era. So the company could still have some major changes going forward. And remember, SoftBank, if they ever want to exit this investment, they may have to figure out how they're going to do that. So in 2020, maybe we'll be talking about an IPO then. It'll definitely be a different story than today's news.
My thank you to Bloomberg's Leanna Baker. And now to some developing news out of the UK. So a UK official has said that the latest Brexit delay means that there will be an election as a result. That same official says this is the only way the country can move on. Now, Prime Minister Boris Johnson's plan to rush a Brexit deal was derailed as members of Parliament dramatically blocked his plan. Earlier, European Council President Donald Tusk responded by saying he'd recommend the EU accept the UK's request for an extension. And coming up, Texas Instruments tumbles. The street does not look kindly at the chip maker's forecast, and the numbers are dragging down other semis. We take a look next. And later, Zuckerberg is headed to Capitol Hill to defend his cryptocurrency dreams, something Secretary Mnuchin says he's had multiple meetings about with representatives for Facebook. Here's what he had to say.
I've met multiple times with the representatives of Facebook. We've told them that we thought that their launch was premature, that they had not addressed fundamental issues around money laundering, BSA requirements, and other.
Shares of Texas Instruments are tumbling in after-hours trading on Tuesday. At one point, they were down more than 9%. This is as the chipmaker posted a weaker than expected forecast for the current quarter. And it's another sign that a rebound in demand for semiconductors will take longer than investors hoped. To tell us more, I bring in Bloomberg Technologies' Ian King. You've been covering the chip sector for us. So coming into this, we were looking for both top and bottom line declines through the end of the year. Does that look like it's playing out?
Well, we were expecting things to continue to decline, but at if you like, a better rate. The declines would be smaller. And what we actually got from Texas Instruments was the reverse. Instead of being sort of a 3-4% revenue decline in the fourth quarter, they're predicting one as bad as 14% at the midpoint.
We had thought that a lot of their sales, about 56%, came from stable markets. You think industrials or auto sectors. Did any of that stability help them?
Absolutely not, no. Communications equipment was arguably their worst market, down 20%. Automotive was also one that they cited as being considerably worse, but they said pretty much across the board.
They do also lead some of the sectors in communications, like you'd mentioned. That's the one area where they don't have a lead. What can we expect from that company in the communication sector going forward?
Yeah, I mean, they weren't at all positive about that. You know, their chips are an important component of cell phone systems. So if you're looking for a read-through on whether the big telcos are spending on their networks, this would not be a good sign.
I want to pull in some conversations we've had about the trade tensions. We did hear from the CFO of the company, Lizardi, and I want to take a look at what was said.
The weakness is broad-based, is due to macro events, and specifically the trade tensions. And if you think about when there are tensions in trade and obstacles to trade, what do businesses do? They become more cautious and they pull back. And we are at the very end of a long supply chain, and when the ones at the very front pull back, it becomes a traffic jam.
So clearly putting a lot of the blame on trade, is that valid?
Two ways to look at it. Up until now, they haven't done that. They've been reluctant to assign blame, to say where this was coming from. Now they said, look, the evidence is just, we can't ignore it. And that, for him, was effusive. But on the call, they were getting a lot of questions along the lines of, look, the overall numbers in the market aren't that bad. How can you prove to us that this isn't you losing market share? Their answer to that was, look, market share in these markets we're in takes a lot longer to shift. Of course it's the economy. Of course it's the trade tensions.
Well, and given the SOX index, all of these chip makers have been such a bellwether for sentiment on trade. Want to come and take a look at a chart here that I'm showing for our Bloomberg audience, and it's that forward PE ratio, and the SOX surprisingly is looking really, really overvalued. At 17, 18 times forward PE, how much more do we need to see to push the sector forward?
Yeah, I mean, it's a very good question. You've had one of the worst years for more than a decade for what's going on in terms of the fundamentals, and yet money has come flowing in on the expectation that we'd seen the worst of it, that things would get better. The actual analysts, to give Wall Street its credit, haven't been believing that. Many of them have been scratching their head and saying this doesn't make a lot of sense, but investors have put money to work. I think we're at a point now where we're going to see that money come tumbling out as reality bites, or we're going to see other companies come in and actually say, no, this is a Texas Instruments specific thing, we're fine. Going to be very interesting. That's what we see in the earnings.
Latest thoughts on all the chip makers. Thank you to Bloomberg's Ian King. Now, embattled EV startup Faraday Future is aiming to raise $850 million by the first quarter of next year. CEO Kirsten Brightfield told Bloomberg that the company will use the proceeds as a bridge to an initial public offering, but did not set a timeline for a listing. Faraday's Chinese founder YT Jia filed for bankruptcy last week and put his stake in Faraday under trust for creditors. Brightfield says Faraday is protected from debt but needs to go public to secure its long-term future. The company is also exploring a joint venture in China to scale production and shield it from tariffs. And coming up, big banks versus fintech. Who do you got? That's the question we'll ask the head of U.S. large cap bank research at Wells Fargo Securities. Our conversation with Mike Mayo, that's next. This is Bloomberg. Lyft surged Tuesday after executives said the company would turn a profit by the end of 2021. That is 1 year earlier than analysts had expected. Lyft has been cutting back on subsidies for riders and drivers that had been racking up costs. Now, the digital banking revolution is hitting one financial institution pretty hard. U.S. Bank will cut several thousand workers at its branches. Bloomberg has learned that it's part of a digital push by the bank. Here to tell me more about that digital push and how banks are keeping up in the digital age, it is Mike Mayo, Wells Fargo Securities head of U.S. large cap bank research and senior bank analyst. Mike, is now the time to finally believe that banks are embracing and integrating this digital revolution?
Absolutely. We think that U.S. banks are on the cusp of the biggest impact of technology on their business in history, and that should be a win-win-win for the customers, better service for the employees, more time to do what they want to do, talk to customers, and for shareholders, the most efficient banks in history, at least a few years out.
Mike, you're wearing a hoodie, so if you're a bank analyst, you wear a suit and tie. Are you now a tech analyst?
Well, I don't think you can be a bank analyst without being a part-time tech analyst. I don't think you can be a banker without having your tech analyst hat on. I think to have banking, you need to have technology. Oh, and by the way, the biggest purchaser of technology services of all industries, the banking industry, spent $150 billion over the past year just on technology. So, you know what? If it doesn't work for banks, it's not going to work for tech. But we think this is the start of not only a beautiful friendship, but the most serious marriage that's ever taken place between banking and technology.
You know, Mike, we're on these analyst calls. I think of Bank of America in particular, highlighting the increased use of payments on Zelle, mobile banking. What area within technology is really transforming banks? Is it peer-to-peer banking?
Well, you know what? Bank of America, you can say, who's going to win, banks or fintech? Well, fintech's going to win. And you know who that is? That's Bank of America mobile banking. In 7 years, Bank of America took from nothing to mobile banking, where they process a level of deposits equal to the 7th largest bank, equal to 1,500 bank branches. That's phenomenal. That's a phenomenal story. In addition, Bank of America, over the last few years, has increased throughput in a variety of ways, mobile banking, ACH payments by 50% or even more. And at the same time, they've reduced their technology expenses for their infrastructure by $2 billion. So you're growing the franchise without growing expenses, and the reason, it's due to technology. So again, it's a fantastic marriage between tech and banks, such as at Bank of America.
So, Mike, if Bank of America is the winner, who's the loser?
Well, you know, a lot of banks are, stuck in an old mindset, a last century mindset. And so you have the largest banks, the scale providers. I mean, JP Morgan, Bank of America, Citigroup, the Goliaths are winning. And you also have the smaller banks, which have specialized services, face-to-face, relationships. They're friendly with the town council and the clubs. But I think other than that barbell approach, those banks in the middle, have a lot of soul searching to do because they don't have the scale to compete with the biggest banks. They don't always have the one-on-one service of the smallest banks.
Mike, we started off this segment talking about a company, U.S. Bank. It's cutting back on some of the branches as it's transitioning to the digital age. Is that the right strategy, or should banks be increasing their presence but hook me in via digital? Well, look, I mean, banks don't have a choice. The world is going in the direction of technology, and banks are going along for the ride. They might not be leading. I think the banking industry, they have been a laggard, and that's out of safety and security for the customers and dealing with regulators. But we forecast a loss of jobs in Wall Street and the banking industry of 200,000 over the next decade. And that's due to automation. Any job that can be automated should be automated. Having said that, the jobs such as advising or technology or anything, dealing with customers, those jobs should be expanding while you streamline the back office. Mike, we love running marathons, so anytime I can read a research note of yours that combines the analogy of a marathon along with financial analysis, you are always welcome back. So saying that, why do you say that we are only on the second or third mile of what is a marathon? Well, here in New York City, we are about to have the New York City Marathon. And that's a very big event, as you can see. But look, when you look at, artificial intelligence, big data, I mean, banks are hardly scratching the surface. It's an archaeological dig to unlock the data they have on customers. I mean, now in Bank of America, again, they took the number of fields to fill out for a mortgage application from 200 down to 10. That makes your life a lot easier, but that's just the beginning of using big data to make customers' lives more efficient and effective. The whole payments revolution, that's changing the reduced use of cash. And just generally, faster processing of computers should allow banks to operate much more efficiently. So you have a combination of software-driven changes such as AI and automation. You have hardware-driven changes due to faster processing and more efficient data centers. Then you have the whole payments revolution. You add it all up, and we get the most efficient banking industry in history 5 years from now. Mike, 20 seconds. Do banks acquire fintech or build out their own platform? Fintech, friend or foe? Both. Banks will be buying some more fintech players, so link and leverage strategy, but they'll also be doing a lot more in-house. Wonderful. Mike Mayo of Wells Fargo, thank you for joining me. Coming up, he is the man Ben Horowitz of Andreessen Horowitz calls the best CEO he's ever worked with. We'll hear from the chief executive of AI startup Databricks. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. AI-based startup Databricks is raking in the investments. Just 8 months after securing $250 million in funding, Databricks has added another cool $400 million from backers such as Microsoft and Andreessen Horowitz. Along with that comes a new valuation of more than $6 billion, and that is more than double its price tag back in February. Here to tell me more about this investment, as well as how Databricks uses AI to help companies organize their data, it is CEO Ollie Goetze. Thank you for joining me. So walk me through your business model.
Yeah, it's pretty simple. So we help companies solve some of the world's toughest problems using data. So in other words, we take massive amounts of data and we do machine learning on it. And we do that in the cloud. So we're a SaaS business. So customers rent our service in the cloud from us, and they pay us by the hour.
Congratulations on the funding. What are you using it for?
We're going to invest over $100 million in our European Development Center. So a lot of it's going to be R&D. We've had massive, massive demand for our service over the last year or two. So we're going to invest that back in R&D, and we're looking at actually over the next 3 years investing in all these open source projects that we lead. So there's going to be dedicated teams for each of these in Europe.
Why is there more demand in Europe right now?
Well, the demand is actually worldwide everywhere. But and we have a big headquarter here in San Francisco with engineers. But there's also difficulties moving engineers to San Francisco. There's visa issues, so balancing the two with Europe and San Francisco is a good plan.
With those visa issues, how much of it is restriction from the Trump administration, and then how do you get around that?
Yeah, it's just we've just seen in the last few years more and more people that get their visas rejected. Some of our current employees that are on visas, they expire, they can't come back. So we're just working around it and trying to expand to be on more places around the world.
With this increased funding comes increased valuation, more than $6 billion. How much of being a unicorn status in this environment helps you or hurts you?
We're not really focused on that. We're seeing massive, massive demand for the service. We're just trying to keep up with that demand that we're seeing. So we're not obsessed by what the exact valuation is or the unicorn status or what the markets are doing. We're not seeing any of that. We're just seeing demand that we need to satisfy.
So investors or customers haven't had increased focus on free cash flow or profitability at this point?
No, the focus is mostly how do we actually grow our business. Everybody wants AI. Every enterprise on the planet, every software company now have realized in the next couple of years they need to build in AI into their software. Okay, and they want to get there fast, and they have deadlines. So they ask us, how can you help us? We need to get there quickly. Please help me. So that's what we're focused on mostly.
What is the most frequent question you get these days from investors?
Investors, I think the most important question that you get is, is AI, is that going to be a threat? How is it going to change society and so on? Those are the kind of questions we often get.
And you mentioned the importance of AI and sort of the race. Who is winning this AI race between the China and the US?
Well, the way I actually see it is that the enterprises that have software today, they're the ones that are going to build in AI in it. They need platforms that can help them, and we provide that platform. So whichever the enterprises are on the planet that are right now, I think actually the ones all over, EMEA, Asia Pac, and United States, all of them are trying to build in this AI technology. So the important thing is we can actually build the platform that can support them.
So AI and big data is all the rage, and up until now it's been a huge growth opportunity. Recently, though, when you have data and in the name of the company, it also is now directly correlated with privacy. What are you doing to help protect customer privacy?
Yeah, so we've actually built technologies that actually help you become compliant. So we have technology called Delta Lake that actually helps companies become GDPR ready or compliant. So a lot of the technologies we build actually help you track the data so that if someone wants to, for instance, find out the data you have about them or delete it, we actually enable companies to buy that kind of technology from us. So we focus on that quite a bit, actually.
One more question here. Yesterday we had a startup on, and he said that it wasn't directly in response to WeWork, but they realized that given the heightened attention on corporate governance, they started having more board meetings. Have you had a sense of doing anything to increase your corporate governance to help appease investors?
No, our investors are super supportive. As you can see, they just, again, we fundraised 8 months afterwards, and it actually was unsolicited. They came to us and wanted to invest. So we've just seen support.
We could all be that lucky. That was Databricks CEO Ali Ghodsi. Thank you so much for joining me.
Thank you.
Now, the new CEO of struggling Japanese supplier of the smartphone screens to Apple, that's Japan Display, says he has about a year before deciding whether to take the plunge on next-generation organic light-emitting diode displays. In an interview with Bloomberg TV, he said the company will, quote, manage our balance sheet well. Take a listen.
We have some new products coming in the OLED side, which we plan to put into the market nearly. And through that, I think we can prove to the outside that our OLED technology is now ready for mass production and to serve our customers. And also, we have some unique fingerprint sensing technologies, which we also plan to put into the market soon. So these kinds of growth drivers, I think, will help us to once we get the money, come out strongly to go into the black side as soon as possible.
One of the biggest concerns for Japan Display is the shift of mobile phone industry from LCD panels to OLED. What is your strategy?
We're seeing some changes regarding the market trend, and due to the point that the price competitiveness and also all of the customers now, many of the customers shifting from just selling the smartphones to rather shift to service or recurring business is a key factor in the LCDs having a much more tendency to be used due to its price competitiveness. So I think those kinds of changes will help us going forward. And, but having said that, we'll keep on building our technology in the OLED side as well and try to be flexible as well, as much going forward.
When it comes to the mobile phone business, of course, CapEx is the name of the game. How do you plan to keep up with the companies that's spending billions of dollars on their own fabrication equipment?
Well, in the past, even in the LCD, I think we didn't manage our balance sheet as well as expected in these kind of big capex-oriented industries. So therefore, even entering the OLED market going forward, I think we should be more smart in rationalizing those things and tying up with business partners or financial partners so that we can not use our balance sheet but enter into the market in a wise way.
That was the CEO of Japan Display. And coming up, Gmail hooked us on free storage, and now Google is making us pay. We discuss the company's plan to have customers cough up cash for more of the cloud. That's next. This is Bloomberg. Google hooked billions of customers onto its digital services by offering free storage. But that is beginning to change. In recent months, the tech giant has whittled down some of its free storage offers. When people hit storage caps, they've little choice but to start paying. Otherwise, they risk losing access to emails, photos, and personal documents. Joining me to discuss, it's Bloomberg Technology's Alistair Barr. So storage is no longer free.
That's right. So Gmail back in 2004 was very famous because it came out and said 1 gigabyte of free storage for everyone, and you know, people used to be obsessed with managing their inboxes with Yahoo and other services, and then it was no longer an issue. And now basically that free deal still exists, but it's not getting better. And then Google has pulled some other strings to make some free cloud offers that it had before basically go away or not be quite as good.
Well, and some of those strings is actually how you stumbled upon this story, right?
Yeah, I suppose that's true. Yeah, so there was a very good deal when you buy a Chromebook, which is the cheap laptops that run Google's operating system. When you bought those, you used to get 2 years of 100 gigabytes of free storage for the cloud service Google Drive. That has now gone down to 1 year only, and it's through this new program called Google One, which is basically a paid subscription program. And basically Google is pushing that a lot more. And so one of the things we found on Twitter especially was Gmail users finding out that they weren't getting emails, and then they were messaging Google and saying, "What's going on?" And they said, "Oh, all you have to do is pay $1.99 a month and it'll be fine." Okay, so we know it costs $1.99 a month. In the perspective of Google, what does that represent to them? Yeah, so $1.99 for 100 gigabytes a month, and then I think it's $2.99 if you want to go higher than that. So that doesn't sound like very much, but I just did some back of the envelope calculations. If you have 1 billion Gmail users, if only 10% of those do the $1.99 a month deal, that's I think $2.4 billion in new annual revenue for Google, which is a lot. And the key here, not only is it annual revenue, but it is recurring revenue. They will count on this monthly and yearly. Is that what analysts had also been hoping for a little bit? Yeah, I mean, it's not so great for you and I because that cost goes on forever, but for the for Wall Street, that's fantastic, right? That's what Wall Street really loves, is a recurring cloud subscription revenue type business, and Apple has done it with iCloud very well for a few years, and Google is kind of following them now.
What is the elasticity, the stickiness of Gmail? So I'm going to pay or shut off my email. What does the customer do?
Yeah, so actually the elasticity question is a really good one. It's not just about email, but it's about all the other files you store, because Google One includes emails and other things attached to those emails, but it also includes photos and things like that. And specifically on email, if I send you an important message and you miss it, that's terrible. And you have all your other online accounts attached to an email account, so it's very hard to change. But then on the photo side, if you have 5,000 photos from the past 5 years, for instance, you don't want to just suddenly delete it or put it somewhere where you might lose those photos. So the incentive is to just upgrade and pay.
And finally here, does Google feel a little bit late in the game? We knew that Apple has been doing this. They're charging 99 cents for some extra cloud storage. Is this Google playing catch up?
I think it's slightly different. I don't think that type of thing plays quite that way, because basically you're either in the Apple universe or you're in the Google universe in the Western world. So the people who are in the Google universe, it's just their time to pay now.
Well, that is a new fixed cost for all of us. That is Bloomberg Technologies' Alistair Barr. Thank you for joining. And it's still ahead. Mark Zuckerberg is headed back to Capitol Hill, this time defending his company's cryptocurrency plans. What to expect from his testimony next. This is Bloomberg. Mark Zuckerberg is defending Facebook's Libra project ahead of congressional testimony. He says the cryptocurrency will not be launched without approval from the U.S. government. I want to bring in Bloomberg Technologies' Kurt Wagner, who is in D.C. preparing for this testimony. Kurt, what do you need to hear tomorrow?
Well, I'm interested to see how much Mark Zuckerberg can actually speak on behalf of Libra. So a lot of the thinking now is that because the association is actually official as of last week, Facebook is now just one of 21 members. What kind of power does that actually give Mark Zuckerberg to talk about the future of the currency? He can obviously share his own views on it. He can share Facebook's efforts around building a digital wallet. But in terms of actually committing to things for the currency itself, I don't think Mark Zuckerberg can say much. And so I'm curious to see how lawmakers will react when they realize the person that they brought here may not actually have all the answers they're looking for.
Yeah, is it notable that it is Zuckerberg and not David Marcus?
Yeah, I think it is notable, and I can understand why the committee would certainly want to bring in Mark Zuckerberg at this point. They already had David Marcus before this very committee back in July. So they've spent numerous hours already asking him questions. Now they want to hear from his boss, and I think it signals that, you know, Facebook is taking this seriously, right? There was a lot of talk in the last week that as a lot of these partners from Facebook started to leave the Libra Association, maybe this whole thing would just come crumbling down. And I think the fact that Mark Zuckerberg himself is showing up in D.C. and willing to take questions is a sign that they see this as something that will sustain and something that they're, you know, going to continue to put resources into moving forward.
Kurt, does Libra's arrival feel dead on arrival to you?
I don't think so, mostly because the whole thing has just been a concept up until now anyway. So it's not as if they launched something and no one's using it, which I think would be a much worse situation than what we're in now, which is they have an idea for something and people have a lot of thoughts about that idea. So it's not so much that they will never get this off the ground, although I think that's certainly a possibility. I think the bigger issue is more they are not getting a lot of public support right now from anybody. And And it's hard to take something from the idea phase to the actual product rollout phase when everyone you talk to about it is basically trying to keep you from getting there. And I think that's the biggest issue Facebook has right now. They just can't get a lot of support. And if they can come out of this week, and if Mark Zuckerberg can leave this hearing tomorrow and feel like he maybe changed a few minds, that this might be a good idea, that's going to be a massive win for Facebook.
Well, they're not getting a lot of support from the congressional side. And then, of course, we heard from Treasury Secretary Steven Mnuchin today. And he said that he's had multiple meetings with representatives from Facebook and that he is saying that Libra feels a little bit premature as well. Does this highlight the bigger headwinds, given now the Treasury Secretary seems to think they have a lot more work to do around this?
Yeah, I think this kind of plays into one of the biggest questions we've had all along, which is who's actually going to regulate this thing? Who is ultimately going to be in charge when Libra exists and people are converting their US dollar or their euros into Libra? Someone is going to have to make the rules, and we don't know who that someone is. And so when I think you see, you know, the US Treasury Secretary come out and say, hey, we need to pump the brakes on this thing, that's not a shock to me, right? No one is saying that Libra should launch right now without any kind of rules in place. But until we figure out who's going to make those rules, it's just going to kind of be more of the same. It's going to be a lot of people throwing out warnings and saying, hey, let's not do this, because no one wants to give a green light to something before the necessary parameters have been established.
Kurt, you're in D.C. We also got some other news around Facebook highlighting that more state attorneys general are joining the New York Attorney General and sort of looking into these antitrust probes. How much more significant is it that now, I believe it's 45 states and some districts and territories are now joining in on this fight?
You know, I'm trying to figure that out myself, to be honest with you, because at this point, there's the state AGs that are doing something, the FTC is doing something, the SEC is doing something. So there is so much antitrust activity happening around Facebook right now that I don't necessarily know which one to be most afraid of. My assumption is that because there is so much discussion, one of these will eventually take the lead and kind of be the front runner on this investigation. But certainly, the more people interested in this, the worse it is for Facebook.
Bloomberg Technologies' Kurt Wagner, thank you for joining me. Now, as we were also talking about earlier in the hour, I want to recap Snap. It had fallen as much as 10% in late trading after reporting third quarter earnings. And while questions still remain about long-term monetization, the company did have strong user growth in the quarter. Snap reported 210 million daily active users of its Snapchat photo messaging app. Plus, the company's shares have more than doubled in value so far this year. Here to discuss it is Michael Levine of Pivotal Research, who has been racing over to us, just getting off the analyst call. What was your question on that call?
Just trying to get a better sense, Taylor, with regards to the revenue outlook. I think there was maybe a little bit of disappointment from shorter-term investors with regards to there being a bit of deceleration in Q4 relative to Q3. And I feel like the company addressed it pretty well. I mean, the U.S. growth, which I think this is still viewed as largely being a more U.S.-centric story, was extremely strong. And they're adding a lot more of the users in rest of world, so there's a little bit of a lag in, but it feels like they're getting the right pieces in place with regards to monetization.
And are you happy with the updated guidance you're getting from management on the call so far?
Yeah, I think they're fabulous results. I mean, there had been a wall of worry with regards to user growth. The user numbers were, as you mentioned, fabulous for the quarter. Outlook was very strong as well. And I think when you talk to the company, and at this point I'd say ownership has probably been a bit more hedge fund centric in nature. They've definitely been spending more time with the long only community. And the feedback that I've heard is basically, it's great. We love to own stocks when they jump 20%. We don't like owning them when they basically go down 20%. So I think they're doing a much more effective job tightening up the range of expectations. And I look back objectively and I'm like 50% revenue growth. That's fabulous. Those are terrific numbers.
Michael, I'm showing a chart here to our Bloomberg audience just of the growth really in those daily active users now hitting 210 million. What else do you need to see from this company to take on, bigger company like the likes of Twitter or an Instagram, for example?
What I've been seeing in terms of the proprietary research that we do, I'd like to see just a continued adoption of advertisers, where if you look at Twitter, Pinterest, Snapchat, they're still slightly more niche by way of comparison versus, let's say, Google and Facebook, where virtually everybody is buying. So seeing that continue to move in the right direction, continuing to see new ad product innovation, I think is key. But one of the things where I feel like I've gotten a lot of questions from investors is they want to understand, what's the opportunity in terms of advertising? Like, chat probably is a slightly harder format to go ahead and monetize in versus, let's say, Discover, Lenses, Snap Select. And I think the message you heard pretty loud and clear from both Jeremy Gorman and from Evan on the call was this is a function of growing demand. There's more than ample supply, and I think there's really a lot of headroom for the story.
Michael, you have to explain this to me. I'm showing another chart to our Bloomberg audience, which takes a look at the percent of short selling of this company. At one point, it was 25–30%. It's now back down to about 12% or so. Why the big short interest in this company? What's the downside? What's the bear case here?
I mean, the bear case is, and you're seeing this with a lot of the other high growth names in both software and the internet that are trading at large EV to multiple ranges. And the reality is, like, it's harder to basically say, I know that this is the exact right EV to revenues multiple that something should basically be trading at. So there's been there's definitely been a healthy retrenchment in the entire sector. And I'd say within that context, Snap has held up pretty well. But one of the things that I don't feel like everybody necessarily appreciates, there was a lot of things going on from an execution perspective, both on revenues and user growth last year, that there's been just a real wholesale change in senior leadership in terms of of Derek as the CFO, Jeremy Gorman as Chief Business Officer.
Yeah.
I mean, at this point, I think you really have totally different story.
We have to leave it there. That was Michael Levine of Pivotal Research. Thank you for joining me. And that does it for this edition of Bloomberg Technology. Join us again next time. This is Bloomberg.